Have you ever wondered how foreign companies raise money in Japan? Today we are breaking down the basics of samurai bonds. The term sounds traditional, but it refers to a very specific type of international debt instrument issued in the Japanese market. A samurai bond is simply a bond issued by a non-Japanese company, but it is denominated in Japanese yen rather than their home currency. Companies issue these bonds to tap into the massive pool of capital held by Japanese institutional investors who are looking for yield. While they both involve yen, samurai bonds are issued within Japan, meaning they must follow the strict rules of the Japanese financial market. These bonds are primarily purchased by Japanese banks, insurance companies, and pension funds seeking stable returns in their local currency. Because the bond is in yen, the company must manage the risk that the exchange rate changes before they pay back the principal. Understanding international debt helps you see how capital moves globally. For more finance basics, subscribe and keep learning.